$1.4 trillion. Let that just sink in for a second. That is the staggering amount of margin debt sitting in the U.S. markets right now in mid-2026. I mean, it's a massive, record-breaking high, and quite frankly, it immediately establishes just how incredibly vulnerable our current market environment really is. It's the absolute elephant in the room, and we've got to talk about it.
Welcome to The Explainer. Today we are cracking open a vital market intelligence briefing to get a crystal clear, structured look at the complex macroeconomic crosscurrents shaping the second half of this year. If you're trying to figure out where the smart capital is actually flowing right now and why these massive numbers matter for your own financial positioning, you are in the right place. We're going to figure this out together. Okay, let's dive into this. We are going to use a strict 4 pillars approach today to separate market illusion from reality, followed up by some fascinating market anomalies and a final synthesis. Here's the rundown. 1. The AI earnings illusion. 2. The strict Warsh-Fed regime. 3. The great sector rotation. 4. Corporate survival pivots. 5. Peripheral signals and anomalies. And finally, number 6, recalibrating your portfolio.
All right, Section 1, the AI earnings illusion. It is time to shatter the illusion of the S&P 500's record profits.
So right now, the S&P 500 is boasting a 14.8% net margin. On the surface, I mean, that sounds absolutely phenomenal, right? That is literally twice the post-war historical average. But here is the catch, and it's a big one. A massive chunk of this is a total illusion driven by AI accounting quirks. When you break it down, a full 12% of the overall Q1 S&P 500 profits were artificially inflated by paper gains alone.
Now, what's really interesting is how this circular valuation loop actually functions in practice and why it's a legitimate threat to broader market stability. Public tech giants, we're talking Alphabet, Amazon, NVIDIA, are utilizing some pretty obscure accounting rules to mark up their stakes in unlisted AI startups like Anthropic and OpenAI. So when those startups raise new funding at skyrocketing valuations, the public companies get to legally mark up their assets and log massive operating income on their balance sheets. It's essentially a closed loop. In fact, Boley and Wang at the University of Florida issued a pretty stark warning about this. Preliminary numbers suggest this effect could be 2 to 3 times greater in the second quarter. Private equity funds are out there collecting massive fees on what are, at the end of the day, just paper gains.
Moving right along to Section 2, the strict Warsh-Fed regime. Let's look at the Federal Reserve's harsh new stance on monetary policy. Listen, if you are still trading on old assumptions, you are basically flying blind. The old playbook relied heavily on Fed speak, press conferences, dot plots, and constant forward guidance to manage all of our expectations. Under the new Warsh regime, that era is entirely over. We are seeing a drastic reduction in communications and a rigid, unapologetic enforcement of the 2% inflation target. Action has completely replaced words. And the market impact? It's undeniable. Even though May's personal consumption expenditures, the PCE, actually accelerated to 4.1% annually, Chair Warsh's blunt declaration to hold that 2% target caused one-year inflation expectations to plummet to their lowest levels of the year. The market knows for sure that he isn't bluffing.
All right, Section 3, the great sector rotation. Let's track a massive, real-time shift in capital flow.
So the momentum in the tech trade, specifically semiconductors, is hitting a massive headwind right now and tipping the scales. The Nasdaq Composite just registered a 5-day losing streak, dropping 4.6%. And what's really fascinating here is Morgan Stanley's Mike Wilson comparing this peaking semiconductor momentum to a late-stage commodity boom. He specifically pointed out how the price momentum mimics the historical lag we've seen in silver stocks. The hyperscaler-led tech rally is, to put it simply, exhausting itself. And this brilliantly illustrates the acute danger of that exhaustion. Remember that staggering $1.4 trillion hook we started with? The market is carrying a record $1.4 trillion in margin debt, which, by the way, surged 54% year over year in May. We are seeing rapid capital inflows from both hedge funds and retail platforms like Robinhood pouring straight into leveraged ETFs that produce 2x or 3x daily moves, not to mention a massive surge in options volume. The system is heavily leveraged and artificially amplified at the exact moment the main engine of tech momentum is stalling out, making the whole structure incredibly vulnerable to sudden, localized shocks.
But the smart capital knows this, which is exactly why it's moving. To offset the extreme risks of this fading tech rally and that looming margin debt bubble, capital is aggressively flowing outward to broaden the base of the market. The primary beneficiaries of this massive rotation, we're seeing it flow into discretionary goods, transports, regional banks, healthcare, and industrials.
Section 4,
Corporate survival pivots. This is where we see how legacy companies are aggressively maneuvering to survive this exact shift.
Qualcomm is a perfect example of this kind of comprehensive restructuring with their ambitious three-layer pivot. At the base, CEO Cristiano Amon's goal is to aggressively escape their historical reliance on smartphones, aiming to cut them down to just 1/3 of total sales by 2029. To make up for that revenue, they are expanding the middle layer, powering consumer tech, like those screens in Mercedes-Benz cars and Meta's smart glasses. But the real apex of their survival strategy is building out a data center inference stack. By integrating aggressive acquisitions like Nuvia and bringing in legendary software engineer Chris Lattner, they are transforming their entire corporate DNA to capture high-margin AI infrastructure before that window snaps shut.
Shifting gears to the energy sector, we can see how this builds into a massive collision of priorities. On one hand, there's this huge government push, with the administration committing $17.5 billion in loans to build new nuclear reactors to meet rising carbon-free electricity demand. But pushing back hard against that is the utility sector. Major players like Duke Energy are experiencing severe budget PTSD. After a recent plant expansion down in Georgia came in more than $15 billion over budget, utilities are opting to just extend 80-year permits on existing plants and flat out refusing to build new ones unless they have direct customer partnerships to cover those construction costs up front. The friction here is immense.
And that friction is forcing defensive pivots and strategic restructurings everywhere. Take Conagra, for instance. Analysts are suggesting that investors would actually prefer an immediate cut to their dividend, which is currently the highest yield in the S&P 500, by the way, just to aggressively fund a portfolio stabilization and pivot heavily into high-protein frozen foods. Meanwhile, you've got Comcast jumping into strategic spin-offs, planning to split the company via a massive, tax-free spin-off of NBC Universal and Sky. These legacy heavyweights are sacrificing sacred cows just to remain agile.
Section 5. Peripheral signals and anomalies. Let's look at the underlying cultural and structural data points quietly shaping the 2026 economy.
I'm going to quickly rattle these off because they are fascinating indicators. First up, labor dynamics. Remote work is actually suppressing youth hiring. Entry-level hiring has dropped over 14% since 2019 because remote environments slowed down the organic learning process. Firms are just opting to invest in older, more experienced workers instead. Second, consumer status symbols are totally shifting. Shiny luxury cars are losing their appeal to young wealthy women who now strongly favor $100,000 plus vintage off-road SUVs. Think classic Broncos and Land Rovers. And finally, a major regulatory shift. The DOJ dropped criminal charges against Abbott Labs regarding the baby formula crisis, opting instead for financial clawbacks. That signals a much broader shift away from the strict corporate enforcement we saw under previous administrations.
And hey, just to inject a surprising 2026 sports anomaly into the mix, consider Germany's Dennis Undav. Statistically, he is outscoring Messi, Haaland, and Mbappé at the World Cup on a per-minute basis, netting a goal every 50 minutes and 47 seconds. Yet, despite being his country's top scorer, his coach continues to bench him, heading into the round of 32 clash against Paraguay. It is just a perfect reminder that in both sports and markets, exceptional statistical performance doesn't always guarantee you a starting position if you don't fit the immediate narrative.
Finally, Section 6, recalibrating your portfolio. So what does this all mean? How do we actually apply what we've learned?
Well, we can neatly lay out 4 synthesized takeaways directly from today's intelligence briefing to empower your strategy for the second half of 2026. Number 1, discount the AI earnings illusion. When you're evaluating tech multiples, you need to strip out that 12% in paper gains generated by unlisted AI markups, and remember that Q2 effect is going to be even larger. Number 2, prepare for hawkish action. Warsh's unadorned declaration means 2% inflation is a hard line. Do not rely on dot plots anymore. Rely on immediate PCE data. Number 3, execute the broadening trade. Semiconductor momentum is mimicking a late-stage commodity boom, so follow the smart capital out of crowded hyperscalers and into discretionary, transports, and industrials. And number 4, monitor margin vulnerability. Which leads me to a final provocative question that I want to leave you with today. With tech momentum clearly stalling out and retail-fueled margin debt sitting at a massive, record-breaking $1.4 trillion, is your portfolio truly hedged against a sudden exogenous shock? The system right now is precariously unhedged, and those corporate pivots we looked at, they prove that the biggest players are already bracing for impact. Take these insights, deeply evaluate your own risk exposure, and ensure your capital is positioned for the reality of 2026, not the illusion. Thanks so much for joining me for this explainer, and I'll catch you next time.